The broadcast is now starting. All attendees are in listen-only mode.
Hi, this is Manoj Abhichandani here, and we're just going to wait a couple of minutes and let other people join in. I can see quite a few are joining in now, so I'm just going to go through some housekeeping issues before I start the webinar. Uh, uh, I think some of you know me. I've been working in the SMSF space now for almost 30 years, and I'm promoting an audit program which I've written online, SMSF Audit. The good news is that almost 62,000 funds have completed audit on the software, and it's very successful. There are many reviewers from CPA and CA who have looked at it and given their green tick on the software. So I'm very pleased, and we have been upgrading the online software quite a few times. And if you're not a user, I invite you to register yourself, and you get to audit 5 funds for free. So if you want to take some time out and have a look at online smsfaudit.com.au. So today we're going to talk about death of a super fund member, what happens and what you're supposed to do when not to use a binding death nomination, and when a death of a member happens in accumulation phase, you have to do a few different things than when a member dies in pension phase. There are certain things which we need to do. Basically, there's a transfer balance account. When a member is on pension phase, we have to credit the beneficiary's account. So we need to, have a look at that. And then we have to look at what is the difference between transferring uh, a pension to a reversionary beneficiary, and this can be done via a death benefit nomination as well. So can the two work together, or are they the same document or not? And then lastly, we're going to talk about death of a member on transition to retirement pension. I recently wrote a newsletter on that, and the government has introduced new legislation. It's in the draft form for public comment, and they're going to convert, instead of converting a transition to retirement pension into an account-based pension, now it is possible to leave it as a transition to retirement pension, and then on death it can be reverted to a beneficiary. So once the law comes in, then it is possible that a transition to retirement pension can be reverted to a beneficiary. Now, just some housekeeping issues. If you look at your panel, you will see there's a phone number provided. So if you can't hear me, so the only choice you have is to dial that number. You will be given a PIN number, and then once you enter that PIN, you'll be able to hear me properly. Um, there's a handout which I have provided to you, so which is today's presentation. So you're free to download that handout. It's basically a copy of the presentation. You can have it open on your screen if you like, but I would prefer that if you just listen to what I'm saying, because I'll be using my pointer quite a bit and trying to show you a few things which you need to look at. Right. The next thing and the last thing is your questions. When I thought of this topic, I thought that 1 hour is not enough. I really need about 5-6 hours to look at each and every point. But what I'm doing today is just touching base with most of the major issues, and this will probably prompt for you to ask some questions. In your panel, you will see that there is an area for questions. So if you don't mind just typing in your questions, and when time allows, at the end of the presentation, I will answer your questions. as much as possible. Now, I've noticed that not everyone asks a question, but if you hang out there for a while and see what other people are asking, sometimes you benefit from what other people are asking, because there's some things which you never thought about and others are querying on it. So let's just kick in. I have a very large number of people who are attending. So we will keep the questions till the end, if you don't mind, and then I'll try and answer as many as possible. Just a standard disclaimer, what we're talking about is legal stuff. We're talking about how a person, when he is in a self-managed super fund, how his benefits are to be paid out. We're talking about estate planning. We're talking about financial advice. So just a disclaimer: all I'm trying to do is trying to educate, and I'm not giving you one-to-one advice. I'm not giving you personal financial advice or estate planning advice. Okay, now when I was in practice, uh, I came to realize very quickly that clients can die at any time. And whenever I would meet a client, I always used to think that that is the last time I'm going to meet him. So if I needed anything to be signed, this was my last opportunity. So if you're an advisor, please take it from me. If you see your client or if you're talking to your client, just assume that is the last time you'll speak to him, because he will not be alive when you ring him next time. I can die, you can die, anybody can die at any time. The problem is that after you're dead, there are certain things which cannot happen as far as superannuation law is concerned. Certain things which you have decided while you're alive, after you're dead, you cannot decide them. You cannot come back from the grave. So ensure that your permanent documents are readily available. I've seen many, many times trust deeds are just lost, and the auditor doesn't care where they are, and many a times they're not signed, not executed. Application for membership is not signed. The person has died and he's had a fund for many years, but he never joined the fund, so the application isn't there. So the money actually is not his, because it may look like his. The money got rolled over and all of that, but the documents are not signed. There are no binding death nominations. There are no pension documents. So at times, some members may claim that they are on pension, but there's no pension agreement. So think like as if you are with BT or AMP or any Westpac fund, and you're commencing a pension. So there has to be a pension agreement, although you may be individuals as trustees, and you may be individual as a member, and you may be agreeing with yourself, but in the capacity of a member of the fund and trustee of the fund. If there's no pension agreement, you're not in pension. Um, and I don't know how auditors allow just a one piece of paper to say that is the pension agreement. Pension agreement usually has quite a few things. There's basically a contract. There's an application by the member. There should be proof that he has actually reached the preservation age, like his driver's license or passport copy. And then what are the terms of the pension agreement, that is on date of death, what happens to the money. So that also should be quite detailed in the pension agreement or in the pension documents. Also, the trust deed, I've noticed, are not updated. Some trust deeds prior to 2007 don't talk about account-based pensions, and some people may die with a transition to retirement pensions, and the trust deed actually don't allow transition to retirement pensions, because these pensions came in 2007 and the trust deed is older than that. So I don't want to dwell too much on this. I think if you are a quality advisor, you will ensure you would have ensured that your documentations are up to date. Right now, let's get the legislation out of the way so that we understand where we stand. So the SIS regulation 6.21 is the one which is the one which you should be looking at, and it talks about compulsory cashing of benefits in a regulated superannuation fund. What compulsory cashing means that um, the members' benefits should be cashed out as soon as practical after the member dies. That means uh, if and when the member dies, he can no longer be a member of the fund, and whatever his balances are, they must be paid out. Now, how can they be paid out? They can either be paid out as a single lump sum, uh, or they can be paid out as an interim lump sum and a final lump sum. So the legislation actually allows only two payments to the single person. So if the spouse is a single person, she can be paid an interim lump sum. That means that if she has any funeral expenses, she can be paid out some money, and then you have to wait till you have done everything, whatever you have to do, like sell assets and credit the member, do the financial statements, find out the balance, and once you know the final balance, you must pay it out as a lump sum. Now, if you do not want to pay a lump sum, then 2B, Section 2B, which is Regulation 6.212B, one talks about one or more pensions. That means that a pension can be paid instead of lump sum, or you can pay a lump sum and the remainder amount can be used to pay a pension. So there are three options: a lump sum, a pension, or the third is part lump sum and part pension. So anything can be done. Um, you must remember that the pension is an income stream, and then it is in retirement phase. So someone dies at the age of 30 and the spouse decides that she needs a death benefit pension instead of a lump sum, then whatever the deceased member's money is, it's in the retirement phase. That means that any income earned by that fund will be tax free. But the way the legislation is drafted, although it's tax free inside the fund, but the person who's withdrawing the money, that means the spouse who's 30 years old, when she receives or he receives the money, he or she will be paying tax outside of super, although there's no tax paid in the super fund. Now, Part 2A of Regulation 6.21 talks about who can receive a pension, and we learn a new term that only a dependent can receive a pension. That means a person, if he's not a dependent, cannot receive a pension. Now, who is a dependent? I will talk about it in the next slide, but a dependent can be a child who is less than 18 years old, and a child can be over 18, but not more than 25. So, a child who's over 18 must be financially dependent on the parent, and then he can continue to receive a pension. And once the child turns 25, on the 25th birthday, the child should actually get a lump sum because the child cannot continue to receive a pension from the fund. Now, if the child is disabled for any reason and he's over 18, and there's a definition of what type of disability, what kind of disability, and in subsection 81 of the Disability Services Act, um, if you have a situation like that, if you have a client who's got a disabled child, you should look at whether that child has that kind of disability and some sort of mental illness in today's kids with depression and all that. You should have a look at that. And it's possible that the child can continue to receive a pension forever. So they come into the same categories as spouses. Right now, when must the child pension cease? Basically at the age of 25, or if it is commuted earlier. I mean, if the child decides that I do not want to receive these payments anymore, we can cash those pensions, and the child can actually receive a lump sum if required, or if they choose to do so. Now, question to be asked: if a member dies. Now we're going to take it slowly. We'll take it stepwise. There are three steps which I'm going to talk about. The first step is the accumulation. A member can die in accumulation phase, and all of us know accumulation phase can cease when you reach preservation age, but accumulation stage can continue till the age of 65, because at 65 you meet a condition of release. And if you have a client who's 65 and over and he's not on pension, there's a problem there. There's a huge problem there, because all the income in the fund can be tax free, and whatever the pensioner withdraws from the fund is also tax free, because the pensioner is over the age of 60. So a pensioner or somebody who's in accumulation can continue working beyond the age of 65. So 66, 67, the person is still working, and the TRIS, the transition to retirement pension, is no longer valid because of the age 65. So whatever is in the pension account can be exempt from tax, and whatever you withdraw could be also exempt from tax. So there are three stages. It's an accumulation phase. An accumulation phase must end at 65, and I've seen funds uh, where the member was over 65 and the accountant was still paying tax on income, and I just simply just don't understand why the member did not decide to commence a pension. Uh, Sometimes I've been explained that if the member commences a pension, then the pension balance will go down, but the pensioner can continue to, if he's working, can continue to contribute into the fund. So you can withdraw one day and deposit it back into the fund as non-concessional contribution. So if you're 65, 100,000 can be deposited till the age of 74, and then no more contributions can be made to the fund. So, so question to be asked from the dependents is: do you want, when you're in accumulation, uh, do you want a lump sum or do you want a pension? Simple. Uh, or the third option being, you want, how much do you want in lump sum, because the remainder can be paid to you in pension. Now, why would anyone want a lump sum? So you should think of the situation from the beneficiary's point of view. So let's say the husband dies, the wife has kids and a home loan. So obviously she would choose a lump sum. But then maybe it's possible that the home loan is already paid off, and if the money remains in super, then it can continue to grow because it's going to be in retirement phase. So whatever money remains for the deceased, there's no tax on income. So it's possible that some of your clients would choose that a pension to be paid. But then when you withdraw the money in the pension phase, then the beneficiary, the spouse, could be taxable on that pension payment. But then it's if the spouse is over 60, and I'm going to talk about all that a bit later. If the spouse is over 60, then no tax is payable. And if all the component of the deceased is tax-free component, and the spouse is under 60, then it is possible that no tax is payable by the spouse, by the beneficiary spouse. So we're going to talk about that a little bit. But non-dependents, you must understand, adult children can only be paid a lump sum. They cannot be paid a pension. So at the age of 25, a child must be paid a lump sum if he's receiving a pension. Now, when a member dies in accumulation, we have to look at the definition of dependent. Under SIS legislation, we got two different definitions. This one is under the SIS Act, and the one is under the Tax Act. They're very similar, but there's a subtle difference between them, and I'm going to talk about that difference. So, for the purposes on who can receive a death benefit payment, it's basically the spouse, a child of any age, and a person of interdependency relationship. And what is that? Someone who is in close relationship and they live together. And when we talk about spouse, just remember, since the gay vote was passed through the Senate, um, the legislation was amended and the definition of spouse was changed, so it could be of the same sex. So we don't have to go into the interdependency relationship which people used to prior to the legislation. Now they can be categorized as spouses. So under where the person is dependent of the person under cis legislation, the tax is dependent on quite a few things. Now, this is the tax which the beneficiary who has to pay. So, tax on death benefit depends on many things. First is if you are a dependent of the deceased or not, and that's a very important thing. If you're not a dependent, then of course you will pay tax. But if you're a dependent and you're getting a lump sum, you're not going to pay any tax. And the tax also depends on whether you're getting a lump sum or whether you're getting an income stream. And it also depends on the deceased taxable and tax-free component. Now, I just want to talk a little bit about a taxable and tax-free component. Now, it's been almost 10 years since 1st of July, well, over 10 years, that we had to track our taxable and tax-free components. And I've seen accountants, they use softwares like Handy Ledger or MYOB or some other normal accounting software. They cannot track um, the various components, taxable and tax-free components within the members' superannuation interests. So I urge you to start from 2007 or from the beginning of the year, and there's no other way. There's only one way to do it. If you haven't tracked it, if you encounter a fund who hasn't tracked the taxable and tax-free component, the only choice you have is start from the year when the fund commenced, and then you look at the rollover statement and any concessional contribution and income credited to the fund. Basically, I'm not giving you the definition, I'm giving you broadly. So any concessional contributions, any income of the fund is taxable component. Any non-concessional contributions, superannuation, co-contributions from the government are all tax-free components. But I urge you to look at the exact definition of taxable and tax-free components. So you have to track it from day one. Have a separate spreadsheet along with your handy ledger set of accounts, and make sure that you divide the two. And at the time of death, you will need to know that whatever is the member balance, how much is taxable and tax free, so that when you're paying a lump sum either to a dependent or a non-dependent, that component is exactly verified. And there are some PAYG withholding rules as well, which I'm going to talk about a little bit later. So we need the taxable amount to calculate whether we are going to hold any PAYG payment if we are going to make a lump sum payments to any non-dependents. Now, tax also depends on your age and the age of the deceased as well. So we're going to talk about that a little bit later. Now, let's look at the definition of dependent under taxation law. That is, it depends if you will pay tax on receipt or not. So, if for this purposes you are a dependent of deceased, if at the time of your death you were the spouse or de facto, which is common, a former spouse or de facto spouse. So it's possible that some payments could be made to a former spouse, and a former spouse will not pay any tax because they're dependents. The other thing is that which they've added is any other person dependent on the deceased. So they've left it open. And if you look at some of the case laws, there have been issues where mothers have claimed that they were dependent on the son, and sons have claimed that they were dependent on parents who were over 25 years old. So it's a little bit open to contest on who is a dependent. An interdependency relationship will depend on whether you live together or not. Now, all the cases talk about where the beneficiary had to prove that they were dependent were whether daily they were relying on the person who has died, and if the benefit is huge because all the taxable component is otherwise taxable. So if you had $1 million fund and all the components were taxable component and you end up paying 17% tax, that's $170,000. So there was a lot of incentive. There is a lot of incentive in considering yourself, if you're an adult child, to be a dependent of the parent. But someone who's let's say the child is a medical doctor or he's a high income earner, it would be quite difficult for them to prove that they were actually dependent on a 80-year-old parent. And if they own their own home and they're paying mortgages regularly, paying for their child's school fees and things like that. In some cases, the grandchildren have been, uh, claimed that they were dependent on the grandparent, and just because the grandparent was paying the school fees has been thrown out by some of the courts because they consider that that's not being a dependent. It's just happens to be that they have offered to pay the fees. So there are quite a few cases. So if you have a situation where you don't have a spouse or a child under 18 and you're looking at person who can be dependent, I think that's where you need to make a few more inquiries on whether your situation, your clients will qualify or not. So when there is a lump sum, anything being paid to a dependent, so whatever dependents we listed on the previous screen, so anything you pay to them is tax free. So we have two components: tax free component, and a taxable component and tax free component. So whatever component we have, if we pay to a dependent, it is tax free. But if we pay a lump sum, then any tax free component is tax free to a non dependent. So if you have a tax-free component, if it goes to a 40-year-old doctor, he's a non-dependent, it'll be tax-free. But if it is a taxable component, so the $1 million fund uh, will pay $170,000 in tax. And this is where I want to talk about a little bit about recontribution strategies. So if you have a client who's 60, uh, and retired, then you can withdraw money from the super fund and you can recontribute. And when you recontribute, it becomes non-concessional contributions. And when you do that, you're basically reducing the taxable component and you are recontributing. And then what you can do is when you recontribute, you can commence pension number two. And that pension number two could be 100% tax free. I'm aware that there is a transfer balance account now, not more than 1.6 million can go on pension. I'm talking about a situation, let's say there's a member who's got $1.2 million and he's 60 years old. He can easily, out of that 1.2 million, withdraw 300,000, and let's assume the whole 1.2 million is the taxable component, that is income of the fund and contributions into the fund where a deduction has been claimed. What the member can do is at the age of 60 they can withdraw the 300, and when they withdraw, and let's say they are on pension and not working, that means they can withdraw more than 10%. As we are aware, If you're on transition to retirement pensions, you cannot withdraw more than 10%. So we are assuming that they are not working. So you withdraw 300,000 and you recontribute. So now you'll have only 900 left. So the way to do that is you check the age, because after you're 65, you cannot do that. So you check the age of the member and you work it backwards, which year they will be 65. So what you can do is at that age, you can withdraw the maximum, which is 300,000, and then work it backwards on. Then you see at what age you are supposed to do the 300, because you should be able to do the whole 1.2 million from the age of 60 to 65. One thing I just want to remind you, when you recontribute into super, if your total superannuation balance is already 1.6 million, you cannot. And there are limits on how much you can contribute once your total superannuation balance reaches 1.3 million, 1.4 million, 1.5 million, whether you can contribute 100, 200, or 300. So you have to time it properly, and if you are able to do that, then you should be helping your clients to convert the taxable component into tax-free component, so that when they die, uh, then if any money is being paid as a lump sum to non-dependents, then they don't have to pay the 17% tax as mentioned here. Now, some of you might think that if one dies, the money can go to the second person. That's well and good, because if it goes to the second person, then everything received by the dependent, the spouse, is tax free. But it's possible, and I've seen it happening. It's happened twice in my 30-year career, where the couple has died together. That means a joint death. And if they die together, then we don't have a dependent where we can pay, and we all we have is non-dependent adult children. And when we have that situation, it's quite possible to, or let's assume a joint death situation. You have 1.6 million, 1.6 million, 3.2 million, and then the person dies, or they have a joint death, and there is no other dependent who we can pay to. So we're talking about $3 million and 17% tax. I think the figure comes to almost $500,000. So it could be quite a substantial amount which could be paid in tax, which could be very easily avoided if you put a strategy into place. But that strategy can only commence once the member is 60 years old. Now, if there is no non-dependent, sometimes the trustee pay the money to a deceased state. When that happens, then the deceased state actually pays the tax. So what the deceased state does, if the deceased state is paying to a dependent, then there is no tax paid to the government. But if the deceased state pays to a non-dependent, they will pay the 17% tax and remit it to the tax office. So when you're receiving this money from a deceased state, technically you don't pay any tax, because if you are a non-dependent, then 17 tax is already paid by the state for you. Now, when a death benefit is paid to the beneficiary as a pension, now we're not talking about lump sum at all. We're talking about a lump sum. We're talking about a pension here. So if there is tax-free component, and the beneficiary or the deceased could be any age, if it is a tax-free component, then uh, that part of the pension is tax-free to the beneficiary. Now you must know that when a pension is paid from a deceased uh, superannuation interest, you cannot cherry pick and say that I just want a pension from the tax-free component. So when the person dies, whatever is the taxable and the tax-free, that percentage, that proportion gets locked in. And once it's locked in for the duration of the death benefit pension, it remains the same. So let's say if 1.5 million is being paid out and 1 million is taxable and $500,000 is tax free, When you withdraw the money out, so let's say you withdraw $10,000, then two-third will be taxable component, which will be included in your income, and the one-third is the tax-free component, which will not be included in your income. And if you are over 60 or the deceased is over 60, the taxable component will be also tax-free. But if both are under 60, that means the beneficiary is under 60, the person who has died is under 60, the taxable component will be included in your income. So if you withdrew $10,000, two-thirds, so let's say 6,666 will be included as normal income, and you'll get a 15% rebate on that $16,666. Now, what are the important issues when a member dies in accumulation? What are the practical issues? Because we want action. We want to know what to do next. The member has died. What do I do? Most likely, and it's unless your member decides to die on 30th of June, most likely he will not die on 30th of June. So what you will need to do is you need to prepare accounts from the 1st of July to date of death. That's the first thing you have to do. Because we need to determine the superannuation interest of the guy who just died. So when we prepare the accounts in the middle of the year, we need to look at the market values of all the shares, and we must allocate income to the various members. Now, where you booked from, there is a webinar which I'm presenting on how to allocate income and how to allocate unrealized gains. And I suggest that if you don't know how allocation of income is done, and if you're an auditor, I highly recommend you to attend that webinar, because as an auditor, we generally don't look at the member balances on how allocation is done. We never do any checks to find out whether the allocation is correct or not. We just look at the minutes, and if the trustees are happy with the way the allocation is done, we generally don't question that. And as an accountant, generally we just trust the accounting software who does the allocation of income. So please have a look at that webinar if you want to know. So we'll have to prepare the accounts, and we have to credit all the income, realized income, and the unrealized income to the member who has died. Then we have to pay a lump sum. Now we have decided that we are going to pay a lump sum, and it's not a pension, and that's what the beneficiary wants. So what you have to do is you have to have some sort of minutes that this person has died. Here's the death benefit. Here's a death certificate, and the trustees have decided to pay a lump sum. And we found out that this person is a dependent or a non-dependent, or there's a death benefit nomination, binding one or a non-binding one, and this is what we are trying to do. Now, sometimes I've noticed that we have only one person with a corporate trustee as a member of the fund, and that there's only one director. That's the problem. You see, the legislation allows that when there is an individual trustee, you can have two trustees, and when there's a corporate trustee with one member fund, we can have another person who's a director of the corporate trustee. And I see many funds, they don't use that facility. And they don't use the facility, what happens? The member dies, and we all running to court, getting a probate, and then getting to ASIC, and we can't even touch the bank account. But if you were the trustee, uh, an individual or a corporate trustee, the other director of the corporate trustee, and since the member has died, you have full control as a trustee. So, just as a practical guide, I would highly recommend you to look through all your funds, which are one member funds, and check how many trustees you've got. You must have at least two. If you don't have two, then this is something which you need to discuss with your clients and make sure that you have trustees. You have two trustees. Remember, in the beginning, I talked about it that when you meet your client, it's probably the last time you'll be talking to him. So make sure that you have two trustees in the fund. The next thing is to get the bank account of the beneficiary, and then you have to register the fund for withholding tax, because if you are paying to a non-dependent, there's a withholding tax requirement. That means 21.5, 22% tax has to be withheld. Now, some of the non-dependent could be living overseas, and the withholding tax requirement is the same. So let's say there are two sons, one is in America, one is in Australia, and the money has to be paid out to non-dependents. So you'll have to withhold from the taxable component, not from the tax-free component. From the taxable component, you'll have to withhold 22% and then pay to the tax office. And then you have to issue payment summaries to the kids where the payment has been made. Now, just a reminder that there were certain amounts which were paid in addition to the member balance. Those anti-determined payments are all abolished from 1st of July, and I'm not going to dwell too much of time on that. Now, some other practical issues: if you have individual trustees, you must. So you had two trustees, one died. So the second thing, what you need to do is that you must get another trustee who may not be a member of the fund. And if it's a corporate trustee, one director member is enough. So if you had two directors, one died, and you don't want to add another one, which I highly recommend that you do. In any case, that person has died. Sometimes we forget to lodge the 484 form and inform ASIC that person is no longer a director. So that must be done ASAP. And there's, I think, some late penalties if you lodge Form 484 late. I think it's 28 days. So if the person dies within 28 days, you have to inform and say this person is deceased and is no longer a director. And sometimes I've noticed that the trustee companies have shares issued, and sometimes those shares have to be transferred to the surviving trustee. Sometimes if you have only one member, you might decide to change from individual trustee to corporate trustee. And sometimes it's a good idea to update the trustee to reflect the current members of the fund. So if you had, say, a four-member fund, one died, you've got only three left. So it's a good idea to just update the trustee, because the previous trustee would still list the deceased member as a member of the fund. The last thing which you must do, which is very, very important, and I've seen this being missed many, many times, that is to lodge form NAT 3036 to ATO. Because if you're an auditor, you need information on what uh, the structure looks like as far as the tax office is concerned, and what the structure looks like as far as ASIC is concerned, and what the structure looks like as far as the trust deed is concerned. And sometimes you'll find that all three do not sync. So by lodging 484 form, by lodging NAT 3036, by updating the trust deed, you'll make sure that all three of them are actually syncing and all three are the same. Now, if the member is in accumulation, should the dependent spouse take a lump sum or a pension? Now, uh, if there is a death benefit nomination, let's say there's a binding death nomination, it can say that pay a lump sum. But if the remaining trustee has a discretion, they can change the lump sum into a pension. And the reverse is true as well, because if there is a reversionary pension, the remaining trustee can change the reversionary pension and withdraw the 100% as a pension payment and take the money out as a death benefit pension. So anything is possible as long as the remaining trustee is the beneficiary. If the remaining trustee is other than the beneficiary, then it's quite possible that the trustee may have their own mind. Um, we discussed about whether the remaining spouse should take it as a lump sum or a pension. We have to look at the cash requirement, whether there's a home loan, things like that, whether they need money or not. And like I said earlier, you can do a mixture of lump sum and pension. So whatever money is required can be taken out. And if there's a lot of money, you don't need all of it as lump sum. Maybe there's 5 million in there, and the home loan is only say 2 million. So you can withdraw 2 million as lump sum and leave the 3 million back in the fund as, and then start taking a pension. The benefit being that it goes into retirement phase only up to 1.6 million. So if there's 3 million left over, 1.6 million can go into a death benefit pension, and the remainder 1.4 will remain in accumulation. But you must remember that it cannot remain in the accumulation of the deceased member, so it must be taken out. So that's one thing. We looked at SIS regulation 6.21. So what we need to do is we need to revert the pension of the member. I'm just going to talk about that in the next slide. Assuming that we have decided to take the pension, and if the beneficiary is also on a pension, so let's say there's a husband and wife case, the husband dies with $3 million, and the wife also commenced a pension with 1.6 million. Now, and if the wife has got 1.6 million in the pension account, she can commute her own pension, and she can put her own pension into an accumulation account, but the maximum she can revert to herself as a pension is only 1.6 million, because uh, a death benefit pension credits the transfer balance account of the beneficiary. So when she's commuting her own pension, the commutation actually creates a debit into her transfer balance account. And once that debit is created, her balance can go down to zero. Now, sometimes what happens is that the beneficiary may have $2 million in the pension account. And when you commute the pension, you can commute up to 2 million. When you commute it up to 2 million, maybe you commence the pension with 1.6 million. So when you started the pension, it was 1.6 million, but the pension has grown. That means the income is more than the pension payments. So the income was say 10% and the pension withdrawals were 4%. So over the years, the the pension account has grown to 2 million. So what you can do is you can commute, the beneficiary can commute the 2 million pension. And if they commute the 2 million pension, you commenced it with 1.6. When you're commuting it, it can create a minus $400,000, because when you commenced it, it was 1.6, but when you commuted it, it was 2 million. So it creates a debit of 400,000. So what you can do is, if your spouse had 3 million in the fund in pension, you could actually transfer 2 million, the 400 minus and 1.6 million, but the remainder 1 million remaining in the spouse's account, because the spouse had 3 million, must be cashed out. It cannot remain in super anymore. I'm going to talk about it in the next slide a little bit more, and I'll show you how it actually works. So, what should the spouse do? She needs to understand, or whether she needs to pay off the home loan or not. And one thing to be remembered is, if lump sum is withdrawn, then it is tax free to the dependent. So that's an advantage. Whether it is taxable component or tax free component, it'll be all tax free. But if it is a pension, then the taxable component is taxable if the spouse is below 60 or the deceased was below 60. So this is where the problem is. So when you are helping the client, the first thing you should know is what was the age of both of them, and then you can recommend whether it should be taken out as a lump sum. Now you must remember, if a lump sum is taken out, then it can be recontributed. So depending on the amount as well. So if it is 300,000, it can be taken out, and then the person can contribute further. Um, and contributions would only be allowed if the total superannuation balance is against the TBA, which is 1.6 million. So, if the superannuation interest has tax-free component, so let's say somebody dies, age 40, and they have 600,000 in super. Uh, the spouse decides to receive a pension. The whole 600,000 is tax-free, and the spouse is also, say, 40. So when the fund pays a pension to her, because it is tax-free component, it will not be included in her income, although she is under 60. It's only the taxable component which is included in the beneficiary's taxable income. Now, when a member dies on pension phase, again, who should get the pension? We have to make sure that the pension can only be paid to a dependent. Um, a non-dependent cannot be paid, so children over 18 and children over 25, if they are not financially dependent, cannot be paid a pension. I've seen some trust deeds, they're very strangely worded, and they sometimes say it doesn't matter whether the person is on pension or not, just follow the binding death nomination. And the trustee has no choice, because the person could be on pension and that pension could be a reversionary pension. But because the trust deed says, look at the binding death nomination, then the trustee has no choice. So you must solve this fight between the trust deed and the reversionary pension, who would be the winner in case of death. And make sure that you use the trust deed, which allows the trustee to do whatever the remaining trustee wants. There should be complete discretion, and the choice should always be there, because it should be to the beneficiary on how they want to take the pension. And some trustee may say, if it's a reversionary pension, you have no choice. You can't pay a lump sum. So then what you do is you take a whole amount as a pension. So there could be some contradictions between the two documents. And then we have to look at whether the valid binding death nomination, what does that say? So if the trust deed says it supersedes, then you have to follow a binding death benefit nomination, and that binding death nomination could be to ex-spouse or could be to children of the ex-spouse. So the best thing to do is, when you're commencing a pension, make sure the client's choices are well documented, and make sure that in case of death, while the member is on pension, it goes to the right person. Now, when a member dies in pension phase, the entries to be done in the transfer balance account, and it'll create a credit. So uh, husband dies, the money goes to the wife, and when a reversionary pension goes to the wife, it will credit the transfer balance account of the wife. But if it is a reversionary pension, an automatic reversionary pension, that means in the pension agreement it is mentioned that it will be reverted, then the credit to the beneficiary's transfer balance account is after 12 months. But if it is not a reversionary pension and a death benefit pension is chosen, so let's say we had uh, a valid binding death nomination, a lump sum had to be paid, then the remaining trustee with the discretion chose to uh, start a pension, so we call it a death benefit pension. So when it is a non-reversionary pension, the credit to the transfer balance account is on the date of death. So the benefit of having a reversionary pension is you basically get 12 months where you can have two uh, transfer balance accounts, one of the deceased and one of the beneficiaries. So the income can actually increase the superannuation interest of the deceased member. Now, beneficiary may already have 1.6 million credited to their balance account, so we know that they have to commute their own pension, and depending on the value of their pension, it can create an extra debit in their transfer balance account. And if it does that, then maximum up to 1.6 million can go into pension phase. But your take now is that if the deceased has more than 1.6 million, or the beneficiary cannot do the debit, cannot commute the pension, and cannot have the debit in the transfer balance account, only that much can be reverted to the beneficiary. Anything extra more than 1.6 million must come out of the superannuation system and paid out to the dependent as a lump sum, as a death benefit lump sum. Now, just one of the last issues, and this is a very current issue, that is to do with transition retirement income streams. So, what the current law is that if the member is still working, you cannot revert automatically on death to the beneficiary. That's the current law. There has been a draft legislation out for comment, and the new law would be introduced very soon. And then you will be able to have a reversionary transition to retirement pension. At the moment, that's not possible. Now, the current law also says that if you are on transition to retirement pension, so let's say you commenced a pension at age 60, at age 65, you're still working, uh, and the transition of retirement has moved to retirement phase because you have met a condition of release by turning 65. The transition of retirement remains a transition to retirement pension, and it remains the characteristics of the transition to retirement pensions are that they are not in retirement phase. So they cannot be reverted back to the beneficiary because the characteristics of a transition to retirement pension is that they are not in retirement phase even after you reach the retirement phase. So they cannot be automatically reverted to beneficiary. So what people were doing is when they turned 65, they were commuting their transition to retirement and commencing an account-based pension. And once they had an account-based pension and they were age 65, then you could automatically have a reversionary beneficiary. Or let's say you didn't even turn age 65, so you commenced a transition to retirement, let's say at age 58. At 62, you retired. So because it was a transition to retirement pension, it could not be reverted to the beneficiary. So because it was not in retirement phase, so the choice you have now is you can only commute that transition to retirement pension, and you can commence an account-based pension. But the new law, which is going to be introduced, it's just at a draft stage. What it says is that let's not worry about whether it's a transition to retirement pension or not. In case of death, we will pay automatically to a beneficiary on death. Um, I would say just if in today, just if you have only one thing to take away is that just remember that your clients can die uh, any day, and there are certain things which you need to do. They can only be done today because tomorrow they will not be alive. So you should be, and don't look at the age of the client. Just think that it can happen tomorrow. So uh, just consider that view when every time you finalize a set of accounts, when you sit down to meet your clients, think about what is left out. Okay, so that's it. I'll just have enough time to answer one question, and I have one from Relene. She says, "Can a death benefit be paid to a former spouse when former spouses are not considered death benefit dependent under SIS Act?" Yes, death benefit, they're not considered as a death benefit dependents, but if the trustee decides to pay, let's say there is no binding death nomination in place and the trustee decides to pay to a prior spouse, we're talking about the taxation effect of the payment being receipted by a former spouse. The former spouse would be considered as a dependent and no tax will be payable. So it's not about whether the SIS law allows it or not. It is the taxable. It's a tax issue whether the former spouse will pay tax on the receipt or not. Thank you very much for your time, and please go back to the page where you booked for today's webinar. There's a webinar next week and the following week. Thank you.